Now you see trend buyers now, trend and breakout traders now. You see this point of interest and they will be like, okay, they want price to break below. There's a fair value gap here. We all know that the market is creating a double top right here to induce early sellers and early buyers to thinking the market will continue going down just because gold is still bearish. There are a lot of factors supporting this bullish analysis, but you not just go and buy blindly. Now they will be waiting for market. I have my my alarm here. So whenever the market closes below this point of interest, if it closes below today or Monday market open, we take a trade from the bottom. But now this is a valid point of interest because this is like an accumulation on its own again. It's an accumulation. Now this is how we trade accumulation AMD in smart money in SMC. See this box, the accumulation. Then you see a candle spike through. You see candles, several candles, they drop down to your point of interest. This is manipulation. Early retail traders will think price is going down. You think we are still bearish. When the price comes to your point of interest, it starts aggressively running back upward. That is what we call distribution or expansion of smart money. Smart money distributing orders. So now, a standard smart money trader or a CRT trader will take his entry from here with the breakout traders, aim for this liquidity here. Now, this is smart money distributing shorts. That manipulation is smart money distributing short orders to short traders to like scalpers, intraday, or not swing traders. This is smart money distributing shorts. That's where you trade your 1 to 5, your 1 to 10, 1 to 15, depend on your risk to reward ratio or your entry model. This is where the whole market, the whole thing gets so excited. The exciting your distribution to your current range high, your range liquidity, sell side liquidity, your target, whichever one. So now in CRT and in forex in trading, there's what we call range liquidity. That is daily range theory (DRT). That's one of my strategies. So this is our daily uh, range liquidity. This is where the crash started. So we mark it out as a range liquidity. Now this range liquidity is the same thing with the liquidity smart money needs for this point of interest. Watch closely. The range liquidity is sitting just below the our point of interest for selling, just below our point of interest, our daily point of interest. So this one now is an inducement an inducement retail traders are unaware of. So we have accumulation, we have a range liquidity, candle range high, candle range low, a candle range sweep, a point of interest. So now what is left is manipulation and distribution. So now let me show you how to get a sniper entry. Sniper entry is all about precision. It's all about the market delivering to the absolute bottom of smart money. A bit crazy. So now this is a this is a valid POI. This is a 3-minute order block. But let's look outside this order block. We have this candle here. We have this. We have this. This is where we take our trade from. If you watch very well, if you watch closely, this is a double bottom. It's a double bottom. So now this is our double bottom. So we look forward to taking our sniper entry from here. Let's go to the 1 minute for confirmation. Now you see creative double bottom. This is where smart money took 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 their how is it called again? This is where smart money started the inducement. Yes, this is where smart money started the inducement, creating the uptrend. So it will come back to balancing the inefficiency of this POI. So let's go back to our 3 minute time frame. So now if we go back to our 15 minute time frame, we see that everything we've done here is revolving inside one point of interest and inside one fair value gap. Now in standard SMC, they'll tell you when you see a fair value gap, you take your entry. Where is that? You take your entry from the 50% equilibrium of the fair value gap here or here. Your stop loss goes just below the week the the order block, and targets the next liquidity pool or whichever one. Now this this is standard this is standard SMC. You want to hit RR. This is standard CRT. SMC rather, sorry. This is standard because I use SMC and CRT. I use SMC for my POI. I use CRT for my execution. So now this is standard SMC. Giving you want to hit RR. It's not bad. It's very good. Very, very good. It's very good. It's very, very good. But I don't trade that way. I trade sniper entry, and sniper entry has 80% possibility, 20% waiting. Sorry. 80 to 70% waiting, 20% possibility, 10% execution. You have to wait 80% of the time, 10% execution. No, market don't reach where you dey go. Your point of interest. Once market retraces back to your point of interest, it's very, very easy for the market to run away. Once they get there, start distributing. And now most of you are aware that price will not just come back, to not just tap into this fair value gap and start moving. Now, price will not come down all the way to this point, tap here, and then to start running back upward. No, it often goes straight to the lower time frame, the hidden POI you never see. That's why some people their stop loss is like 1 pip, one or 3 pips, 4 pips. This is the hidden this mark. So this small line I drew here, it's an hidden point of interest you never see on the chart unless you go down to the lower time frame. This point of interest is never seen, and the market has 20% chance of delivering price to this point of interest. But it's still possible of doing it. It's still possible that the market will do it, but only if there are a lot of buy orders waiting here to be taken. So now we take our trade, we'll go back to the 3 minute time frame. So that's where we'll take our trade from. So we'll take our trade from this line and our stop loss just below this our point of this order block here. Take our entry from here, stop loss goes below this point of interest. That very easy, very easy, very easy. It's not complicated. It's very easy and too good to learn, but it's not easy to master. Sha. It's very easy to learn, but it's not good to master. It's not easy to master. So now we target the opposition. Eh? In CRT, we target the candle range high from 1 to 8 risk to reward ratio. We now have a 1 to 31 risk to reward ratio. We are now risking $1 to make $31 on Euro USD. That is a standard candle range high point of interest. Now, this range liquidity is the absolute weak of that yesterday daily candle, of this candle range. This candle range weak, the highest point price reached yesterday on yesterday's daily candle. This is the liquidity. That's what we call range liquidity, or rather, that's what I call range liquidity. I've hardly seen people use this range liquidity on CRT. I've hardly seen people use a setup. If you extend the market to this point of interest, you get a 1 to 43 RR. But this is my target, 50% level. You 1 to 55 RR will be that trading zone. Now, keeping our stop loss here is good. It's good, but it's against Euro USD has my broker HFM. I use HFM. They have their spread is a bit wide on Euro USD compared to gold. So that's why my stop loss is there. But this is structural stop loss. This is the actual point where we keep our stop loss. See, you see what I mean? This is the actual point where we keep our stop loss, giving us a higher risk to reward ratio. So now when price comes to our fair value gap now, you see that when price taps you in, you see price going against you for like few pips, like couple of, like 10-15 minutes, and then you see start seeing profit. That's time that the candle keeps going down. When you think the market is having a retracement, the market is not having a retracement, or the market is not going against you. The market is just the market delivering price to the extreme point of interest, the extreme discount, the deep discount, the hidden point of interest that retail traders don't see. That's where the multi-time frame confluence comes in. That's where the multi-time frame analysis takes place, and it is multi-time frame that gives you a tighter stop loss like this. So now I will adjust my stop loss again to this point of interest. Now this gives us a 1 to 115 RR. This is our stop loss here. 141.89. 141.89. Now giving us a 1 to 100 RR, and this is just about roughly how many pips. This is like I'm coming um this is 1383 pips, 1383 pips. It probably take a day or two to hit our TP. Yes, because the target is very, very high. Target is we are targeting the opposition, the 50% level of the daily fair value gap. So these are risk parameters now. This our stop loss right now is not up to the dollar now. It's not up to pip. See, our stop loss is like 1.212. Okay, our stop loss is 0.12 pips. I be 12 pips. Okay, stop loss now 12 pips now. 12 pips target.